Thank you for joining today's webinar. We are really excited about today's topic around protecting margins against currency volatility, and more specifically, talking through navigating the rising impact of foreign exchange as it relates to the global medtech industry specifically. We're also joined by two great speakers today who I'm excited to introduce shortly. But first, we wanted to do a little background on my Caribou. So my name is Robert Bast, and I am the Chief Strategy Officer and one of the co-founders here at My Caribou. And we've built a global platform that really does three major things. First, it helps you to build partnerships in over 150 countries with over 22,000 manufacturers and distributors in those countries. We have a set of tools to help you manage and collaborate with your partners all over the globe. And finally, as part of our focus today and in partnership with Grain, we've developed powerful foreign exchange, hedging, and international payment tools built specifically for the medtech industry. So with that, I thought it would also be interesting to quickly show a breakdown of registrations for those who are joining today's session. As you can see, we have a good representation from all around the world, with the majority of attendance clearly being in Europe and the Americas. And I can also tell you in the background that the breakdown is approximately 60% distributors and 40% manufacturers. So I think both of those statistics line up well with some of the things we are going to be speaking to today. So that leads us to today's topic and our speakers. I'm excited to be joined today by Jacques and Dor. Jacques is a transformational leader with over 25 years of experience, including Executive Vice President Healthcare at Alstom, President of Cardinal Health EMEA, and Vice President at Hillrom International. Jacques has successfully developed medical device businesses through organic and external growth. Having worked on all continents and in multiple areas, he has a diverse cultural and functional background, and he has established and led large direct and indirect sales organizations in multiple countries. He now focuses on helping investors identify, execute, and operate acquisitions in medtech globally. We're also joined by Dor, and he is the co-founder and CEO of Grain and has over 25 years of experience in finance. Formerly, he was the co-founder and managing partner of a hedge fund manager called Blue Orca Capital, as well as the managing partner of Horizon, a crypto liquidity company that he helped found. So thank you both for joining today. And with that, I'm going to pull up ourselves here. And welcome again, Dor and Jacques. It's great to have you both. Before we get into the questions, I just wanted to point out to the listeners or those that have joined the sessions today that there is a Q&A button at the bottom of your screen. Feel free to click on that and submit questions as we're going through the session today. And we'll do our best towards the end to respond to those towards the end there. So with that, I think we'll kick off. And Jacques, I'm going to start with you. So the first question we have here, what are your thoughts on the challenges medtech manufacturers and distributors face as it relates to currency exchange and global payments?
All right, well, good morning, good afternoon, everyone. Of course, currency exchange rates do play an important role in the relationship between medical device manufacturers and international distributors. Currency fluctuations, they do represent a business risk or a cost that is part of doing business internationally. So I think that the challenge is that, when you have business relationships, whether it is for developing and strengthening a position in a specific medtech market, or for a single tender or an opportunity in the short term, these relationships are always built over a period of time. There's a time for negotiating, a time for contracting, another time for potentially winning a deal. Then there's orders, then there's shipping, invoicing, and finally, at the end, the payments. And these delays, they happen both for the manufacturers with the distributors, but also for the distributors with the final customers. So that just creates this massive timeline and the big difference between when you decide on the price, for example, and when you actually get a payment. So during that time, exchange rates between the currency of the distributor and the currency of the manufacturer, of course, will change. And this change can have a very large impact on the profitability of the deal, and both ways, for the manufacturer and for the distributor. So that's why actually a key discussion topic between distributors and manufacturers is the decision of the currency of the transactions. If it is the currency of the manufacturer, then the distributor will bear most of the currency risk. And if it's the distributor currency, of course, it's going to be the manufacturer. And in fact, when you look at a distributor contract or distribution contract, you can assess where the power lies just by looking at the currency, right? If it's the manufacturer, it means that they have most leverage in that relationship. If it's a distributor, it means they probably have most leverage in the relationship. So it's a big deal. And I've been sitting on both sides of the table as a manufacturer and as a distributor. And I have seen firsthand how currency fluctuations can completely destroy the value of a deal. And even years of business relationships between two industry players, can be completely wiped out just by currency movements. So, of course, there are ways, right, to protect a company against these exchange rate fluctuations, and we'll talk about this. But these can either be challenging to secure, for example, for a distributor when they don't have the proper size or the financial health, or they can turn out to be too expensive to use in the course of the business. So it's really a real topic in relationships on the international markets.
Yeah, and you speak to the fact that it is, and I've heard this in many of our conversations over the last several months. It's both an issue for manufacturers and distributors, and certainly it seems to be an ongoing concern and an increasing cost, which I think ties into kind of the next question for Dor, which is why are banks and financial institutions exchange rates so high? Why are the costs so high historically?
First, thanks for being here, and great to meet all of you and talk today. It's to answer your question, it really is about two factors. One is the size of the market and its structure. To give you a little bit of numbers, every day the FX market turns over $6.5 trillion of trading. That's $6.5 trillion every day. About 5 of them is in hedging. However, when you look at and break it down, 92% of that immense daily volume is done by institutions, banks, sovereign funds, very, very large financial players. Only 8% is done by corporations. Of this 8%, 90+% is by large corporations. Think about Fortune 500, 1,000. So really medium-sized companies, let alone SMBs, make up less than 1% of the FX market. So, and they're highly, highly fragmented. So they have no leverage. They're the tiniest player and they don't get attention. It's better to pay attention to somebody who's trading 100 million, and those are the tickets, 10 million. And in fact, you can't even get access to a trading desk at a bank at less than, $1 million. So that's one issue. Then actually delivering FX is a highly fragmented supply chain. Actually, at the end, you need somebody to have the currency. So when you're taking euro and you want to exchange it to Mexican peso, as an example, somebody actually has to have those Mexican pesos. Right. It's not your local bank branch in California. It's not even maybe the bank headquarters in New York. It's actually some bank in Mexico that's going to deliver the Mexican peso in exchange for dollars. So what happens is you've got a highly fragmented supply chain. So a lot of middlemen, in other words. That's why medium-sized, small-sized companies that consume FX pay very high middlemen, costs and don't have leverage. And the difference between what a large player will pay to what a medium-sized player would pay can be 70 to 80x more expensive. So it's that 70 to 80 times more expensive.
Oh. Yeah, I mean, it's incredible, and certainly hearing a lot of the similar kind of feedback as I was saying earlier. Not to mention, I think, as volatility seems to increase, the lack of tools available to address some of these things, as you were saying, to kind of the smaller and mid-sized organizations, or even, even the lower end of large. So I think, to that point, and I guess, Jacques, for you, can you share some examples or instances where currency volatility impacted your company's bottom line specifically, and how you've adapted business strategies in the past to navigate those types of challenges?
Yeah, sure. I can give some examples, more or less dramatic in consequences. So, in all of my career, I've had significant part of my business that was either done in another currency than my company, or with partners that operated in local currency that was different than mine. So, as I mentioned, and I've been on both sides of the fence, manufacturer and distributor. So,
Yeah.
So typically, when I dealt with somewhat stable currencies, with stable economies, the volatility did have an impact in, for example, hitting a quarterly target or a specific business unit profitability, but it didn't swing the fundamental health of a business one way or the other. So here I'm thinking about volatility between the US dollars, the euro, the British pound, or the Japanese yen. So they don't help the financial forecasting, but it's manageable. When you have a solid size of recurring business. But there are also other situations. As a manufacturer, for example, I face situation of very high volatility in EMEA in countries like Turkey, like Egypt, or like South Africa, and these can completely change the value profile of a business in such country. Sometimes you've been creating and investing a business, a market in a country, and then the currency gets in the way of really developing a healthy relationship with the local distributor. So, as an example, as a manufacturer, at point in time, it was as extreme as we had to decide to exit completely Turkey as a market. There was just no possibility for us to maintain a profitable business there. This was done despite years of developing the market for our therapies. We had to waste all of this investment with our local partners, with key opinion leaders, and we had to leave our patients with the task of finding an alternative in the market. And all of it because the Turkish lira just went spiraling down. It was just out of control. But then as a result, because we exited, local players then started to fill the gap in that market. And then guess what? At a later stage, they started to look at entering our European markets and competing against us. So some short-term, issues can actually lead to more middle-term and long-term challenges in even your own market. Another example, was a multi-year, very large tender in Egypt. It was multiple months between our decision with the local distributor to apply, to decide the pricing strategy, and then the deal being awarded to us. And then before all the hospitals in Egypt placed their orders, and then we shipped, and then finally we got paid, weeks, months, and even years went by. So, originally we celebrate the win. It was a very large amount. Was a real recognition of the work that had been done by our distributor in the country. But then, down the road, a few months later, the currency changes completely wiped out the profitability of the deal for our local partner. Because we are dealing in our currency, we were protected, but then all the risk was with the partner. And the problem is then you still want to protect your brand. You still want to service these customers. So we had to revisit with the distributor the terms, so that at the end they could still make some money out of the deal, and also us, but at a much lower profitability. So those are example of I'd say pretty dramatic situations. The other way around, sometimes you have a year where suddenly a business in the country is suddenly super profitable just because currency is working your way. And that's great, but it's not sustainable growth, in the sense that the following year, if then the currency normalizes, suddenly you've got a bunch of favorability that is disappearing, and you have to make it up in some other places. So both ways actually work into challenges in managing the business.
Yeah,
Can
that's
I
great.
maybe just also
Please.
add a perspective? So I think what Jacques is talking about is absolutely spot on, and ties to the perspective of manufacturers and even some distributors. But we also should take into account that the last 10 years up until 2 years ago was pretty subdued environment in terms of volatility because of low interest rate and inflation. When you actually look, and we've studied this quite a lot, when you look at the last 25 years of data, your chance of getting hit by more than 3% on the top line on the dollar euro, which is a very stable, right, perceived currency, was actually 1 in 5. Now, if you're a distributor and your profit margin, your operating income is 5%, a 3% hit wipes 2/3 of your, 3/5 of your profit. If you're in a down year, you're out of business. Now, we haven't seen that in the last 10 years, but volatility has really picked up. It actually is back to where it was in the period prior to 2008 when central banks started to really lower interest rates. So you have the business aspect of managing contracts, and you actually need to keep an eye on how FX doesn't kill you. It can make you a great year, but it can put you into trouble. And we've seen companies go out of business or lose the ability because of cash constraints to do fundamental, to win business because of FX. And we're probably back in these environments in 2022. We had a year like this of monthly movements of 5% in the dollar, pound, euro to other major currencies. This is a topic that's back on the spot.
Yeah, it's certainly hearing that with some of the financial professionals that we're speaking with, and that they're expecting and seeing that increase. The other interesting, I think, we often talk, and we were talking about the specific cost, right? The direct cost, but there's the broader impacts as well in terms of how it affects supply chain, payment terms, and even Jacques, the example of pulling out of a market. The cost and the impact of that is so much greater than just the potential basis points. It's such a big cost overall, and certainly, Dora, as you're saying, if that's going to increase the volatility is going to increase, that impact's only going to grow if we don't have tools to address that. So it actually leads very well into the next question for you, Dora, which is what role do currency hedging tools play in managing some of these foreign exchange risks historically, and what are the key considerations when implementing these types of strategies?
Sure. So I'll give you kind of a blunt answer from the up until recently. They kind of sucked. Unless you were a really big corporation with a highly sophisticated treasury department that could have specialists working on this really regularly, even they would actually only hedge 70% of their exposure, because fundamentally it comes down to projecting your P&L and balance sheet. And that's a really hard problem. And then you have to deal with bank counterparts. It was a tool accessible for big boys. Technology has really changed that. Now technology allows us to deliver a complete hedging tool, or it's not even hedging, it's simply locking a rate on a future receivable or payable at the click of a button without the need to manage collateral and positions and all that. A machine does it for you. It does it better than a human. And really now this is a tool that's accessible to medium and small size companies that if they're not aware of the possibilities, it's truly a shame, because sometimes you can even make money out of hedging. Not just protect yourself and get certainty, just lowering your cost. I mean, we'll talk about it probably But if you're coming from developed countries into developing countries, you can exploit some really neat corporate finance concepts that the machine does for you and actually lower your cost by 1, 2, 3% when you're either receiving money or paying your supplier. So over the last 2, 3 years, and that's why we thought what we're doing with Caribou is really exciting, is that you can now basically get in the box hedging without the effort. And that's a big development for a lot of distributors and manufacturers.
Yeah, listen, I can say, historically, and I know, Dora, you come long history, and as well, seeing kind of the tools and how they've developed myself even over the years, being kind of historically from the fintech space. It's incredible, some of the tools, and certainly you alluded to kind of some of the things that we've introduced. I know we can talk about that more later, but it's incredible to see what actually can be done with some of these like very innovative and almost intelligent tools, right? So and I guess we've talked a little bit about kind of the broader business impacts. But Jacques, I want to kind of shift here a little bit and kind of speak specifically and asking around in what ways that the currency fluctuations actually impact international trade agreements or the contracts themselves, and how you negotiate those. And how have you adjusted your approach in response to these changes? So we talked a bit about the volatility, and now how does that kind of bleed into some of these other things? Yeah.
Well, it's clear that when you're discussing a contract, typically you renew your distribution contract once a year. There's a number of terms that you kind of review. Some of them are kind of fixed in the contract, and you don't review that so often, and some do, right? Pricing, for example, is reviewed on a regular basis, but also other terms, and of course the currency of the transactions is one of them. And sometimes you reopen that kind of worms when you have a specific large deal that you want to discuss with your manufacturer or with your distributor, to see if it makes sense to change the currency. So there's times where we have to decide a deviation from the regular distribution contract for a specific deal, and then we agree to use a different currency. That has happened in some cases to prevent the situation that I just described before. So, for me, currency is really an integral part of the business relationship, just like exclusivity, pricing, rebates, payment terms, Incoterms, shipping terms, investment plans, shared investment that you want to do with a distributor, the cost of regulatory filings, the information you're going to share with the distributor or they're going to share with you. So the point is it's one of many components, and all of them are really defining the framework of the relationship. And currency is not a small part of it. And I don't think that it should be brushed on the side as a no-brainer. I think that as a distributor, I was very keen on focusing on that specific term because, as I mentioned, it could completely swing the risk one, very important risk one way or the other. And just like Dor mentioned, this 3, 4, 5% can really make or break your P&L at the end of the year. So, yeah, I mean, again, it depends a little bit of who is holding the pen of the contract. And as I said, this is very much a signal of where the power lies in the negotiation. If you are a very strong distributor, you own a specific pathology or a specific surgical procedure, and you have a manufacturer who wants to add their product to your portfolio, you're going to probably be able to negotiate your local currency. But otherwise, in most cases, unfortunately, the manufacturer will dictate their local currency. So, no, yeah, it's definitely something that does impact contracting and the development of relationship.
So
yeah,
maybe, sorry.
No, Dora, please, yeah, go ahead.
So listening to Jacques, I thought just how crazy it is, because FX is really somebody changing your price on a minute by minute basis without your control. So somebody is managing your price without you having a say. And if you thought about it, I mean, people spend so much time deciding prices, and then this outside factor out of their control really sort of underseats them. Now, what's interesting is, Jacques, you talked about who has the leverage in the commercial contract, but that's why I think if we can use technology to sort of level the playing field for both participants, that actually takes away the need to fight over it. If we can guarantee the rate, add certainty to a transaction via hedging at a very, very low cost, which is critical, right? Because we're a distribution, we're talking about distribution, low prices to begin with. We really can have a win-win. Neither side need to take the risk. Neither side needs to have their prices dictated for them on a minute-by-minute basis, which is by itself probably, in my mind, worth far, far more than the direct economic consequence, because it alludes back to what you said about having a great relationship, and the next year having a lousy relationship, whereas it's nobody's fault, and you lose. You spent years and years, and you lose it because, you know, FX moved against one party. And by the way, in that sense, the statistics is that once we go into a negative year in FX, and this is, by the way, I'm talking euro to dollar, a very major currency, it's more likely than not that the next year will also have the same phenomena. Meaning if the euro is depreciating versus the dollar, it's likely that it's not going to reverse in the next year. And the data actually shows that it will take you about 19 months to 20 months to recuperate the FX loss you got hit, which a lot of people think about FX as random walk. It's true, it's random walk over long periods of time. But as Kate said, in the long term, we're all dead. So you better think about the medium term. So you don't want this. I think you want to be smart about it, assuming you can find it at the right price point, so that it doesn't, it's not a headwind to all the good stuff you've done that you can control.
Yeah, it's great insight. You know, and to your point, Dor, I think some of these tools, as you think about negotiating on the front end, certainly takes pressure to some extent off of, you know, some of these concerns, but then the ongoing impact that this has and the constraint it can put, you know, you're talking about the time it takes to recoup some of those losses. You think about the strain that puts on the partnership for the remainder of that relationship. And then, Jacques, to your earlier point, you know, does that then require someone to pull out or to reduce order flow? So certainly some significant impacts. And you know, as we kind of been alluding to, there are tools to address this now. So so Dor, another question I guess for you on, you know, talking about currency fluctuation impacts on investment decisions and capital allocation strategies. And, you know, I'm thinking about this more for multinationals and again, in our space, certainly a lot of multinationals, but I know you have experience obviously outside of Medtech. So, you know, more broadly and as it relates certainly for our industry too, I'd be curious on your thoughts.
Yeah, sure. And it ties to a question I just saw in the queue. People who are smart about it realize that nobody knows where FX is going to be as I speak. You don't take a bet on rates. Once your financial exposure is created, you lock in the exchange rate and hedge it until the time of settlement. So if I've got a receivable coming in now, I lock in the rate when the receivable is opened and vice versa on the payable, and I move on. What's important is that I do it in a cost-effective manner. That's a separate topic, but you don't say, okay, listen, I'm going to wait for the dollar to the Japanese yen to hit a certain rate, and then I'll lock it in. That's actually how FX brokers make money on you. They give you advice. They send you all these nice projections of where your currency will be versus other currencies. They have no clue. and then they offer you really sophisticated multi-layered hedging programs and all that. The smart way to do it is to micro hedge each transaction. You get a transaction, you immediately lock in the rate via a simple forward contract, or let a machine do the forward contract for you, like Caribou smartly has done, and move on. That's it. Don't spend, like, be very disciplined about it. It's when the guessing and saying, okay, I'll wait and maybe it will get better. You're in a casino and you're betting your profitability in this casino. So stop. Don't enter the casino. Just, eliminate and get certainty and focus on managing your business.
It's great insight, and I like how you alluded to a casino, because it is often without these tools you are to some extent gambling on the future and what that impact is ultimately going to be to your bottom line. And when we talk about the impact and some of the impacts we've talked about, do you really want to take that risk or effectively gamble that? So I'm gonna change I'm gonna kind of bump forward to a question for both of you around kind of what you both foresee as it relates to global trade in medtech and the associated risk with FX. And Jacques, I might start with you on that one. How are you seeing global trade in medtech and some of the risks associated to that, in the time ahead, in the days ahead?
Yeah, so I think this is not going away, right? I mean, medtech is a global market. By large, there are some differences by regions and countries in terms of how we handle some therapies, but typically a patient is a patient. So I think it's a global market. Technology that works in the US will work in another market. So international presence is a must if you are a manufacturer, because that's how you recoup your R&D and some of your regulatory expenses. And all distributors to be relevant and to have the best solution for their customers, they need to be able to source and get access to the right medtech technologies globally, wherever it is, to be able to win in their local market. So global trade is part of doing business in medtech, and FX is part of the game, and it can't just be ignored. Now, as healthcare players, I think, as I described, I think we've been a bit, looking at this as a necessary evil, and then we kind of let it, yes, we indeed, as Dor said it, we let somebody else or something else decide profitability on some of those deals for us. And I think we need to be smarter, and we need to be more efficient in how we manage the currency risks, so that we can be successful and we can grow profitably while allowing better care access for more patients. So volume matters in that business. So, we should be focusing on this. We should be focusing on getting more patients on our therapies. So I think today technology, as Dor alluded, is opening possibilities to have an easier way, because it has to be easy. It has to be automated in somehow as much as possible. It needs to be cheap, right? It needs to be predictable. And it needs to be accessible to all types of size of businesses, from the small distributor who is only present in the region of Turkey, to a larger one that is covering all of Germany or all of Mexico. So I think that we need to start looking at those solutions, and when we have found a good tool, we should share it so that our partners should also get access to it. I think as a manufacturer, you should make sure that distributors have access to it, and likewise, if you're a distributor, you want to make sure that all your manufacturers have access to it. To your point, Dor, so that currency is a lot less of a driver of business, and it's more around profitability, pricing, and value added that you bring to the market.
So on that, if I can bring the perspective from a global trade at large, I think all of us read the newspapers, and we're entering a period where geopolitical, unfortunately, conflicts are rising. Yeah. Big geopolitical conflicts are rising. Yeah. They're not going away. Nations are arming, defense budgets are increasing. The place of the US is being competed between China, Russia, and all that. These things are growing, and they don't typically shut off in a year or 2 or 3. These are multi-decade phenomena. We went through a period of peace in the world. We're going, unfortunately, sadly, through a period of instability. Instability means volatility. Volatility means FX rates move. So bring it up in your priority. And I'm not saying that because I'm from the field. It's truly because we've went through a period of peace and it's gone from FX volatility. So that's one thing. The other thing, start simple. Figure out I'm using $500,000 worth of foreign exchange every quarter, every year, every month, and take just a simple haircut off it and lock the rate and do it. Start to manage your business from a point of view of FX budget rate. So you control the situation and it doesn't control you. Set aside, okay, if I'm buying $1 million worth of equipment using FX, I'll start with 50%, 70% that I'm always locking at the beginning of my financial period, quarterly or monthly. That would be my recommendation. And lock the rate. Now, you don't have to convert. You don't have to spend your working capital which is an ineffective way, right? It's got a direct cost in terms of interest, and it's a bigger hassle for you from a cash. So all you need to do is just lock the rate on those amounts and then use up that guarantee. That's how you can start simply. And start to use it as a budgeting tool and drive to that budget tool. It will drive discipline in how you manage your business from that perspective.
It's great insight, Dor and Jacques. Yes. So just being mindful of time, we did have a few questions come in. And folks, if anyone else has more, certainly feel free to put them in the Q&A. And if we don't get to them, and I think we're probably only going to get to 1 or 2 here, we'll certainly reach out with answers to those questions after the fact. But I think, Dor, this might be somewhat directed at you, and Jacques, you might have some insight. And I might tie it to kind of another question as well, Dor. But I've heard this before around, why not just do spot on a regular basis? Why not just continually, do spot conversions? And wouldn't that just protect you in the same way that, that hedging would? And I'll add to that again, like, how much savings or what would be the difference? And then I guess the part that I'd like to tie to that is a little bit about the technology, because we have talked about that. So what are some of the technologies that are now available that are going to help, basically solve for this? So I'll leave that to you.
Sure. So it's probably the worst thing you can do, because when you're constantly converting spot, first you're moving along with the volatility and you're paying your bank for conversion, which you don't when you hedge. I'll explain in a second. So you're effectively running with volatility and paying a conversion price on that, and banks really screw you on that. So that's one thing. The second thing is that you lose out on the benefit of hedging beyond the certainty we talked about of managing your business and knowing this is my FX budget rate. You're also in a lot of cases giving up interest rate differentials, which can lower your cost by several percentages. By and large, we see that by hedging, we typically generate more than a 25% saving, direct saving on a per transaction basis. And it's either by avoiding loss, exploiting interest rate differences, because when you're locking a rate on currencies that have higher interest rates, that you're going into to the future, you can get the net present value of that. I won't go into it, but basically the hedging tool gives you that. So don't do that, and don't miss out on the benefits. Now, in terms of the tools, you guys figure out that you want to help manufacturers and distributors come together and do business more effectively. And I think what you've done, like many other supplier distributor marketplaces in recent years, and I'm talking the last probably 2 years, when technology got there, you allow today either a supplier or a distributor to both convert at very extremely attractive prices, but also to lock the rate. They can now go in, lock $500,000 worth versus the currencies they need, and that's it. They're protected. They don't need to deliver the money when they do it. They only deliver it when they actually do the payment, so they don't lose on the working capital. And you've just provided them a tool that up until recently was only available to a treasurer of a company with tens of thousands of employees. It's at the click of a button, and it actually is at the price point that competes with the biggest players out there. So it gives it's a do-it-yourself solution that is simple and available. So I would really encourage people to consider that.
That's great. Listen, I somewhat biased, obviously, but again, saying, as we say, like historically, these types of tools haven't really been available to the average organization, and they are incredibly powerful. And Dora, you really speak so well to kind of the spot versus hedging, and again, having access to some of the tools that typically or historically would only have been available to multinational billion-dollar organizations are now available to the smallest to mid-size company. So certainly very excited to be bringing that to bear. I'm going to end on one. Sorry, did you want to say something?
Yeah, I just saw a question come in at what cost. I want people should realize that sometimes it's at the cost of the current spot locked into the future. Sometimes it's below that.
Right.
Sometimes you can actually get your dollar or your euro to work 2, 3, 4, even 5% better because it's delivered in the future. Check it out.
Yeah. I was going to go directly to that question, Dor. So thank you. And I on that, I think so we are coming to the end. But I will say, so to that point, feel free book a live demo, with someone from our team, and I'll actually pull that up so everyone can see some of feel free to contact me. Before I do that, I just thank you, Dor, Jacques. This was, as expected, a great session. Appreciate your time and your insight. Further to kind of what Dor was just speaking to, if you are interested in seeing live rates, seeing how the tool works, or certainly talking to us about anything else, you can see for those who haven't signed up where to sign up, or feel free to reach out to myself directly or Lindsay, who's the head of our customer excellence team. But for now, we want to thank everyone for joining. Really appreciate your time. Once again, thank you to Dor and Jacques. I think this was a great session, and I hope everyone has a fantastic day. Okay, take care.
Thank you.
Thank you.
Thank you.